Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. Today is Thursday, November the 4th, 2010, and like we do every night, it's time to look at the markets. Check this out. Okay, before we get started today, I'm going to speak very candidly with you, but before we do that, first off, I want to thank Gary for his phone call today. I appreciate that very much. First off, what I'm going to talk with you today is kind of give you a complete understanding of something I believe has been missed here, and I think it's important everybody learn this. Uh, and I know that I'm one of the few bears left out there, but again, I'm going to show you today why the bullish argument is absolutely ridiculous. First off, this chart here is of the NASDAQ. This is the 2007 peak, okay, back, you remember that time period. And I want to show you how I keep talking about the gaps and you know, one little low volume gap here, one little low volume gap there. It's telling, but when you get a string of them, it's even more so, okay? And back in 2007, we saw a huge string of gaps that were just unbelievable at the time. We had 1, 2, 3, 4, 5, 6, 7, 8 at that time, okay? And I mean, I was blown away by that because that's just unheard of. Typically, you get 3 to 5. It's a really good situation for the bears to come in and just gobble that up. But on occasion, you get more than that. I mean, that you're talking about averages, and you know, averages aren't set in stone. So on occasion, you'll get above average or below average situations. So in this one here, you were extremely above average, and I noted that at the time as being a very bearish sign. At the same time, you had really low volume here. We'll go into all the signals that are here back in the '07 situation. And you had these sell signals like we have in the current situation. We had these shooting star inverted hammer situations back here, here, here. Okay, all that stuff was in play. You had at the same time major, I'll get to that in a minute. Right here you had a bearish setup where you had a low point of the slow stotch to here, another low right here showing a downtrend. The corresponding low points here, okay, and here we're showing an uptrend. This is known as a bearish setup, and you don't want to trust the rally. It's something you want to be shorting. Now, bulls back then and even now would be saying, no, that's a hidden divergence and blah, blah, blah. It's not, but in any event, that's what they would say in response. Back then, you had a breakout of a previous high. Here's a previous high, so you had resistance at this level. You had a breakout above that, okay? You'd already had, what, see 1, 2, 3, 4, 5, 6, 7 gaps below you when that happened, but still the breakout made people think, hey, we got a higher high, this has got to be a reason to be a bull, right? Wrong. You advanced up here and you kept going. You got a bearish divergence formation here between the high point of the slow stotch and the lower high, okay? This is also confirmed on the RSI indicator. And at the same time, you were getting high points or higher highs in price activity. The main thing I'm trying to draw here is you had all these sell signals just like you do today, but back in 2007 you had all these sell signals and the market just kept fighting. It just kept fighting. But had you simply looked at all the gaps in play, you could have said safely and securely, it doesn't matter what happens to the upside, it will all be erased. That's what that technical analysis of the gaps is telling you there. Like we showed you yesterday when we showed you the actual empirical evidence of that. It's substantially high quality indicator whenever you see one, much less a string of ridiculous gaps in a low volume rally to the upside. A couple points to note here. You had a low point at 23.86 and you rallied to about 475 points from that point here to this high point here, okay? And you rallied all the way up here about, like I said, 475 points, which was overextended on top of that, okay? So once you had the breakout here, you didn't have to concern yourself with anything else. It was an easy short because the market would have to actually, didn't matter what it did, it would have to pull back down and consolidate upon the previous high point, as this was resistance. Now it would be supposed to be acting as support, and then you would see the pullback regardless. So it didn't matter what it did, okay? Another thing I want to point out here is if you had been absolutely insane, you could have shorted every single one of these days. I mean, every day, all the way up to the thing. And you guys know the end of the story. At the end of the story, you made a killing, all right? The bulls who got caught in it, well, they just don't talk about it anymore. The exact same situation was set up prior to the flash crash. You had a low volume rally, about 6 or 7 different gaps in it. These are the things that I spotted before it happened and said, this isn't right, it's going to crash, short it. And I was about 2 months early, but either way, the end result is going to be a total fail. And again, had you gone back and shorted every single day prior to the flash crash, you would have made a killing as well. So one of my point is that you didn't have to time it perfectly. You didn't have to do anything. The truth was going to be evident and in the future and make you money. Okay, so that's how I did that. And back here in '07, you can see this pattern consistently is, like I said in yesterday's video, I've said before, you don't get all these gaps like this unless you're in a peaking mode. That's those low volume rallies that you don't want to be buyers of, you want to be selling them, okay? Okay, quick look at the volume back in '07. You saw, like I've talked about before, substantial sell volume coming into play. This was superseding previous buy volume, erasing it, so to speak, bearishly engulfing it. It was telling you that the trend was shifting. At the same time, you had that rally. We talked about the 475-point rally. That was on low volume. Note it's below this red line here, okay, which is coming down to, I think it hit a low of about 2 billion shares. Main thing to draw out from this is that the volume we have today in today's market for this time period, this rally we're seeing now, is actually less than the volume we had back then. Another telltale bad sign, okay, for bulls. Again, you had the bearish crossover. More importantly, you had the extension up to that point where that was the only logical conclusion. It may not happen today, may not happen tomorrow, but you start to get up there and you tighten up and you're getting that preparation for that move to the downside. Again, whenever you hit the above the or at or above the 70 line of the RSI, this guy right here, this indicator, you're getting extremely overbought. Okay, so back here you hit it, all right, bounced off of it. Back here you went well up into it. So all these signs were there, which the perfect stock alert method technical analysis would have obviously pointed every single one of these out to you as the same ones I use consistently again and again. So my question, of course, is why would someone tell you now it's different? All right, it's not in any way, shape, or form. Every single time that you get these conditions, it's telling you buy and sell pressure never lies. You can always trust your chart because of that. It's just reflecting buy and sell pressure, and it's telling you that there's no true buying going on into the rally to the upside. And in fact, it's got all these signs that are going to actually end up turning around and absolutely erasing all of it, okay? Okay, here we are looking at present day, the NASDAQ present day, and we're looking at, you've got the major rally, note the low point here, 2099 all the way up here to 2577. Okay, you were trading above the upper Bollinger Band line in the previous example. You're there again here. You've got not 7 or 8 gaps, you have 10 in this string right here alone, not counting this stuff back here or the one you can't see anymore that's back there. You've also noticed that you're up 478 points from your low point. Okay, that's overextension. The previous one we showed you was 475, something like that. This one's 478. Okay, so all the signs are still there. You've got the bearish divergence formation here, here. Okay, all these sell signals, the shooting star formation here, here, here. Okay, all that's still absolutely identical. You've got the bearish setup right here. Okay, between those 2 points and these 2 points, showing you that this right here is actually not true. And you even have a breakout of the previous high that's back here. All right, I think it's around this area. All right, you've got a breakout, which is going to get a lot of people thinking, hey, we've made a new high and it is a bullish market and so forth and so on. Okay, and like I said, whenever you've got 1, 2, 3, 4 huge string of gaps like that, you know otherwise. This is not a quality advance. It's a low volume advance, just like the one I showed you in 2007, just like the one I showed you back before the flash crash, all right? Okay, here we are looking at the volume substantially greater on the sell side than anywhere else on the market or on the chart there. You don't see any other major buying superseding previous selling, which means the real trade, the one that people put real money behind, is the sell side. You'll notice it's, like I said, a low volume rally behind the advance to the upside. All right, all this stuff right through here. And again, you've already made the advance up to there where you tightened up, and now you're preparing for that bearish crossover. You can get a blip to the upside. The market doesn't have to turn around just because the sell signals are there, as 2007 proved and as the flash crash situation proved. But my point remains the same, and that is that all the signs are there telling you this is not true. It's not a real bull market in any way, shape, or form. And mainly, you want to look at this, the RSI. Okay, whenever she hits 70, that, okay, or above it, she becomes extremely overbought. And the only time that these conditions are sustainable is when you have substantial buying behind it, and we don't have that. So this is actually a peaking signal, which all signs are telling you this exact same thing from a technical and fundamental standpoint. The fundamentals are the things that hold up the market price. They're the things that actually people are seen as growing for the future and therefore propelling the market forward. But with our fundamentals, we don't have that. In fact, if you're watching the news coming out of Europe, it's getting worse day by day. The cost to manage their debt is going higher and higher and higher. That's a breakout you want to pay attention to because that's a structural issue that's going to actually end up seeking the markets. But we'll get into that later. The main thing I want to point out here is that all the conditions are the same. Whenever you do your review, if the evidence tells you, historically speaking, again and again and again, this is not a bull market, don't buy that this time is different. It's not. I may be the only guy out there, bearish anymore, but I've got it for a darn good reason. All right, all the evidence is in my favor, and that's important. Again, I'm not selling you anything. All right, I'm out here every single day working my tail off, paying for this thing, so I could tell you this information. It's not to, do myself any favors. It's actually to try to teach you how to read a chart and trust a chart. That's the most important thing. Maybe you like it, maybe you don't, but at the end of the day, it's right. Okay. Not been to our free website at perfectstockalert.com. It's right there. It's 100% free. You'll find all kinds of cool stuff there, including a projection for what we expect the market to do the following day. We do that every single night. It's on our website on the MPT rating. We expect today's rally. It was no big surprise to us. We don't have a problem with a move to the upside. We're just telling you that it's absolutely not a bullish opportunity. It's a fake, and you need to treat it as such. Okay? Maybe the last bull on the planet? Probably not. But in the end, you're going to see that the charts never lie. Okay? Pretty cool, pretty simple. Quick look at our disclaimer. Okay, for those of you who would like more information on that chart of the '07 market that I was showing, the peak, I've put it in the traders forum. It's called 2007 peak. You can go there and check it out. It's always there. That's the MPT rating for you right there. Also, at the very edge of the site, we had the video swing trading course. I got some free course lessons in there and some videos that we'll email you to show you how to spot quality long and short opportunities. Very simple method, but it'll keep you safe, and that's the most important thing. Okay, now our disclaimer. The disclaimer, read it and weep. God bless, take care. I hope to see you all tomorrow in our next video.